As multi-asset investors, we seek to capture value wherever that may be. However, as we do not have special skills in every asset class ourselves, our value add is to select the teams that we feel do offer that alpha generating opportunity in the space concerned. Tim Creed is head of Schroders Private Equity Investments, which is a significant team of over 150 employees. That strength and depth of resource is crucial, and I'm delighted that Tim is here to explain in more detail what they bring to our investors. Over to you, Tim.
So the presentation topic is about what really is venture capital and growth capital, and how can you make sustainable returns. So it's quite a broad topic. So I've got a few different sections to this presentation. The first part will be to introduce Schroders Capital, just a couple of slides. Then there's going to be a chunk about what is venture capital, what is growth capital, which seems a rather obvious thing to talk about. But I've noticed over my time that if you get 10 people in a room, you might get 15 or 20 different definitions. So I think it's worthwhile spending a few moments on that. And then I've got a couple more sections where we go into some of the challenges today, and then how we see the market and what we believe that investors should focus upon. So starting with Schroders Capital, so this is really a repeat of what was just mentioned. So Schroders Capital private equity is about 15 billion. We cover the full private equity landscape. We have about 150 people, and I'm one of the 4 global investment committee members and in charge of the private equity investments. No story on private equity would be complete or would even start properly without something about performance. So we have to have this, or we choose to have this at the beginning. This is the slide that we call our everything in one slide. And as much as I love private equity, it's fair to say that people within private equity are quite good at making their performance look really good. So therefore, what we want to do is just say this is everything. And so this is everything we've done, the good, the bad, the ugly, venture, growth, buyout, realized, so sold companies, as well as unrealized existing companies. And what we do is we put all investments in the calendar year of when we made the investment, and then we say, what is the IRR of those investments? So choosing one at random, 2013, you can see it's just above 22% net IRR to us. And I kind of chose that one because the aggregate of everything is 23% net IRR, which I think you'd say would compare favorably to public markets. And really that comes out by the fact that over this whole time, we have about an 8% outperformance. So the other way to look at private equity is using what's called a multiple. So this is the cash on cash multiple. And normally people would just use the numbers on the right-hand side, but we do like to be a bit more transparent about everything we've done. So what this slide shows is our direct investments and co-investments. And here I'll say another word. As a platform, we invest in direct investments and co-investments, and this is where we invest directly into a company. We also invest into secondary transactions, where the most common one at the moment is something called single asset GP-led deals. And this is where we carve a company out of one fund and put it into another fund as a single asset. And then the third thing we do is we invest into funds themselves. So if you think of a famous venture capital fund in the US, in Europe, and Asia, the groups like an Accel, Sequoia, Charles River, etc., we are fund investors in most of those groups. And the reason we do that is because that provides the investment opportunities for our single asset GP-leds and also for our co-investments. But this slide is purely the direct investments and co-investments. And here you can see on the left-hand side, we've completed 200, just over 200. We have 50 that have been realized, and realized is the word for fully sold. And so the other way that people within private equity talk about their performance is they say their realized gross results. And for us, it's 28% and 2.9x. So if I was to say, if you think about our performance, if you just say 2.9x, then that's a good place to start. A nice topic about fees, because of course you have to make sure that private equity has fees and you're very transparent about the fees. Now let's move into private equity and what is private equity. So we've got a couple of slides on this section. And the first one is really to set the big picture and to really emphasize about what makes it different from public markets. And you see here that there's 4 things that are mentioned. The first is really rather obvious, it's not listed. But I really want to focus on the other 3. Private equity is active management, and it's active in 2 main ways. The first is we choose the companies we want to invest in. If you compare this to public markets, for example, in the UK, there's a few hundreds of companies that are public. If you compare that to private, there are millions of private companies in the UK. If you extend this out to Europe and you extend this out to the US and also to Asia, there are tens of millions and hundreds of millions of companies that we can choose from. So the active ownership is really, it starts with selection. We have a very big pool of companies to choose from. The second part of active ownership is that we really work with our companies. Either we work directly with the companies to help change them, or we work with our private equity managers that we co-invest with to help change and improve those companies. That active change, active improvement, whether it's through add-on acquisition, whether it's through expansion to a new geography, whether it's new products, whether it's helping management or enhancing management, whether it's strategy, is really vital. And I would always argue that that element, the selection of being able to choose between any companies, plus the active ownership of changing companies, are really the main differentiator between the private markets and public markets. There is, though, two extra points that I think are worth mentioning. The third is aligned. Through the whole private equity landscape, we have, we believe, a greater alignment of interest from the end investor through to the private equity manager, through to the management team, through to the employees of a company. And that normally manifests itself in equity ownership. Most of us will only get significant payouts if the equity value of those companies significantly increases over a prolonged period of time and we sell the company at a significantly higher price than when we invested. The final area is illiquid. It's clear private equity and venture capital is illiquid. Most vehicles are 10 years long. Most investments are 3 to 5 to 7 years. There are nuances, there are differences. There are 5-year vehicles, there are 15-year vehicles, and then there are also investment trusts that are, of course, evergreen vehicles. But one thing that should be noticed or noted, that even in the shorter duration vehicles or even in the evergreen vehicles, there's a long-term mindset. So the individual investments are always very illiquid. It's not possible to buy into a private company and then sell out of the private company in a short period of time. So this is a slide which sometimes gets passed over, but I do want to spend a few moments on. This slide really shows the 4 main segments of the private equity world: venture, growth, buyout, turnaround. Now, within venture, I'm going to emphasize 2 main parts. The first part is seed stage, early stage, which is Series A, Series B rounds. The second part of venture is the late stage, the Series E, Series F pre-IPO rounds. Now, the way we look at the world and the way that we've looked at the world for the last 25 years is that first part, the seed stage, early stage, is a very attractive place to invest and has been an attractive place to invest for many, many years. The late stage is very pro-cyclical. The pre-IPO stage has great moments, but it also has terrible moments. And if you look at the history of venture, there have been 2 periods where late stage has been hit with a huge boost and then a huge crash. The first was the classic dot-com boom and bubble, boom, and then the crash of the bubble. And the second is actually what's going on right now with late stage, where it's had a very good run for the last few years, but is in the middle of a crash. They're the 2 segments within venture I'll say a few words about. The second area is growth. I was in a meeting earlier, and someone asked me, what's the difference between late stage and growth? And the way I would describe it is that venture has clear financing rounds of Series A, B, C, D, E, where different investors come in. Growth, however, is a growing company. In almost all cases, it's profitable or near profitable, and it will only have 1 round of financing. Sometimes 2, but really it's 1 round of financing, and it's into a profitable company to make it grow further. And that's the difference between venture and growth. The growth companies really are already sizable, more profitable companies. The third segment is buyout. This is small buyout, mid buyout, large buyout, mega buyout. Small and mid is the bulk of the industry by numbers. The large buyout and mega buyout is what you read in the newspapers with the take private of Asda or Sainsbury's, etc. Or the more recent one that's been in the news about Boots. And the final area is turnaround, which is really fixing a company. Now, across this spectrum, across those 4 categories plus the subcategories I mentioned, our strong belief is there's 2 areas that investors should avoid. Unfortunately, they are the 2 areas that get probably 90% of all media attention. And those 2 areas are late stage venture and large mega buyout. And for our strong belief is they are the 2 pro-cyclical areas. We believe that gets 90% of media attention. It also gets a lot of investor attention. But the reality is, for the people within private equity, those two segments are actually not very important. Those two segments account for about 5% of deals. So the other 95% of deals were the other segments I mentioned. It should be noted, though, that they do also account for probably 30+% of the capital invested. So there's good logic why it's in the media. However, what we would always like to say to people is that you should really focus on all the other segments I mentioned. So the seed and early stage venture, the small and mid-stage buyout, and then turnaround, because those segments are 70% of the capital, 95% of the deals, and they're the areas that consistently outperform rather than go through boom and bust. This is a slide about venture. So although I've just said about late-stage venture and pre-IPO, there's a reason why it's always in the news, and that's because of the unicorns and decacorns. A unicorn is a venture capital-backed company that's worth more than $1 billion. A decacorn is a venture capital-backed company that's worth more than $10 billion. So far, the number actually went a bit above $1 billion, above 1,000. There are over 1,000 unicorns out there. So this is not companies like Google or Facebook that were unicorns at one point and then IPO'd, but are now public companies. These are companies that are still in the private world. We, within Schroders Capital, are investors in about 135 of the unicorns, and we're in 80% of the largest decacorns, so 8 of the top 10 companies. The key, however, for all these investments that we've been in, but also our strong recommendation to investors, is you must get in the seed or early stage. If you join one of these companies in the late stage or the pre-IPO, you are then going to be affected by the boom and bubble that I just mentioned before. This is another way to talk about some of our exits over the last couple of years. Here it just mentions the top 10 liquidity events. So a liquidity event is basically the cash-on-cash return that we've received. Interestingly, we had an IPO last year of Airbnb. That's not on this list because we actually didn't get much cash back, because that was a company that we invested in at kind of the mid-stage rather than early stage. So all these, the reason we got 60 times, 30 times, 40 times is because we were in there right at the earlier stages. I'm just conscious of time, so this is another way of showing some of the logos. Again, venture capital often has logos, so these are many of the other companies that we've invested in. Now let's go into challenges, because challenges is clearly something that happens right now. We are in a clear challenging market. Everyone's seen what's happened over the last couple of years. I don't need to rehash the world news, but there are challenges. So what I'll do is I'll focus specifically about the venture and growth segment. And this slide has 3 different sections. The first section is what we call our fundraising indicator. This is basically a different way of presenting the normal slide that shows fundraising per segment. The reason we do it like this is on the left-hand side, it shows venture capital fundraising with an 80% confidence interval. So you expect venture capital fundraising to increase year on year. That's generally a good thing because there's more companies being created globally. What you don't want to see, though, is far too much money in the segment. And what you see back in 2000, the red line went way out above the 80%, and hence there was too much money. You also see what's happened in the last 2 years. There's been far too much money going into venture capital. And that's been driven primarily by hedge funds and asset managers who focus on public equity who are trying to go a bit earlier. The middle chart shows the effect of that on the number of unicorn creation. You can see that huge explosion because when you have too much money, it looks for companies to invest in. And so the slide earlier had 1,000 unicorns. I'd like to emphasize or highlight that that's probably too many. And you can see why there. On the right-hand side, you see the amount of capital that's gone into companies from a different perspective. So this slide, on the right-hand side, we look at the average growth in funding round of 3 different stages. So Series A, seed, Series B to E, and Series F onwards. So over time, over the last 5 years, it's every 5 years, the fundraising rounds do increase a bit. And so to see an increase of 2-fold over 5 years is about the long-term trend. And so this last 5 years, for seed and Series A, it's been similar. What you see, though, on the right-hand side is the Series F round, sometimes also called the pre-IPO round. Those companies are now 10 times more expensive than they were 5 years ago. Now, A lot of people have claimed in the last couple of years that's because we're at some form of quantum shift and it's different dynamics and blockchain is changing the world, medical devices are changing the world, etc. And some of that can be true. There has been a lot of innovation in this last 5 years. However, it cannot take account for or cannot justify a tenfold increase in our view. This is a slide that shows a different story, but kind of a similar message. This looks at slightly more established companies and looks at companies that are the SaaS companies. And you see here the correction that has happened over the last couple of years, where you see that the NASDAQ is traded down and also SaaS, that's software as a service valuations, have also traded down significantly. So, what about the opportunities? Because that was a bit doomy gloomy, wasn't it? This is a slide that just talks about some of our exits and our emphasis on early stage. I'll actually skip this because I think this slide here is more important. What this slide shows is our view of the differences between early stage and late stage, and we split it between these 4 characteristics. If you look at valuations, our strong belief, and this is built upon not just the last 5 years, but we've been investing in venture capital now for more than 25 years, is that even with the dot-com boom and the big boom of the last couple of years, venture capital has consistently had steady valuations in early stage. And to give this in a bit more examples, we are investing in funds as well as companies, I mentioned. So if you look at Google, there was only 2 venture funds that backed Google. We were in one of them. So our investment in 1998 led to a huge IPO in 2004. We were super happy about that. There's further stories about Google as to whether we really should have sold everything in 2004, considering the way Google has gone. But the story behind it is still that there's a great company that was founded in 98. If you got in at the seed stage, early stage, then you made a great return. The late stage, as I say, is highlighted there. Competition, for us, competition for venture capital series, early stage and seed stage, there's a core group of venture capital managers who have proven themselves through cycles. I've mentioned a few names, the Sequoias, the Accels, the Charles Rivers, Redpoints, etc. If you look at those venture funds, they are all highly access restricted. You can't get into index even if you wanted to. Index close funds within minutes, effectively, and they choose the investors that they want. Fortunately, we've been invested with them for many, many years and in many of their funds. The benefit of that is that when they have a co-investment and they need a co-investor, they go to their long-term investors. But it does mean that to do venture capital, you have to be in venture capital for many, many years. It's not a segment you can dip into and dip out of. And I think that's one of the big challenges of the last couple of years. There's a number of investors who try to dip into venture capital as it's become more exciting. The bottom topic is about burn rates. A lot of people say that with larger companies that have raised these large funding rounds, it's okay because they can change their burn rates. They can simply recruit fewer people, or they can maybe even fire a few people, but they can carry on growing. That's possible when you're a small startup and you have 20, 30, 50 people. It's a lot harder when you're a late-stage investment and you have 1,000 or 5,000 people. The ability to change your cost base at that level is really, really hard. Some of you may be aware of the firm Sequoia. They did in fact, actually, Tim might speak about Sequoia later on because he knows them well. They produced a letter not too long ago that basically told all of their investee companies to control their cost base. And they did that some months ago in preparation for what's going on now. So all companies across the venture spectrum, from venture to seed stage to late stage, are paying far more attention to their cost base. The key is that earlier stage companies have more flexibility. So one of the questions that comes up is now a good time to invest? Our strong belief is that you must invest in venture throughout. And one of the justifications for that is because good companies are created constantly. And so clearly we've chosen very good companies for this example, as you'd expect, but I think the message really is there. And that is, if you look at the companies that were founded, the top part is just before the 99, 2000, 2001 boom and bubble and bust. And what you see is if you look at the companies that were founded just before that, Google, PayPal, Salesforce, those companies, they were founded, they grew a bit, they then faced a horrible recession, and yet they came out of it super strong. So market-changing, game-changing companies can be founded before a recession and still plow their way through it. Same with companies that are founded just after the recession. Facebook was founded in 2006, and yet it carried on growing. It came out of the problems of the dot-com crash didn't affect what effectively at that time was a dot-com company. Clearly nowadays Facebook is a very, very different company, but that innovation that was required in 2006, 7, 8, 9 really came from its earlier years. So what we see is companies can be founded throughout. If you look at the bottom half, that's looking at the more recent GFC, the global financial crisis. You see the companies on the left, like Airbnb, but also the companies on the right, Moderna, Uber, and Stripe. These were founded afterwards and have really, really significantly grown. So our strong belief is you must stay in venture yourself because all there are good companies that are created throughout cycles. Within the world of venture, we look at a number of different segments. These are not the only 6 segments that we follow or that we target, but these are 6 of the segments that we think are particularly important where game-changing companies can happen. And I keep referencing this game-changing phraseology. The reason for that is because venture capital is not an incremental business. There are companies that make great returns, the 5x, 10x, 50x, and there are write-offs. You need to have those game-changing companies that can deliver 10x in order to compensate for the ones who don't make it. So you really got to think big and go for high-quality companies. There's 3 characteristics that many of these logos, and I should say these logos are all in our portfolio, 3 characteristics that I'd say pretty much all of them have. And I don't wish to summarize our venture capital into 3 sentences because our global venture team get crazy with me when I do. But the 3 things we really look at is we've got to have a great idea. So it's got to be a great company. It's got to have a really good proposition. Secondly, it's got to have a really great management team. It is the management team of these companies who drive their growth. And so the quality of management teams is essential. And the third is it's got to have great co-investors, great venture investors who are backing that company because they will be there through the different cycles as and when needed, and they can really help the companies grow. So as long as a company has those 3 things, then it's likely that we're going to invest, as long as it also fits part of our long-term themes. Couple of slides on the SUPP, the investment trust. So I presume most of you know a bit about the investment trust. It's a UK-based investment trust. It has historically had a focus on UK companies. In the last few months, we've actually extended the strategy to make it global. And the reason for doing that is because we found a number of great UK companies, but really in order to maximize the total returns, considering our platform is a global platform, and we have offices in the US, we have offices in Asia, we've been investing in Silicon Valley and the US since the 90s, we've been investing in China, we've had a Beijing, Shanghai office since 2000. We strongly believe that you should have a global outlook, and so we've recently extended the strategy to be global so that we can then target the best possible venture-backed companies globally rather than just in the UK. But you see some of the key points on the right-hand side which kind of reinforce or sit with the 3 things that I summarized earlier. This is the 3 parts of our core strategy. So within venture, it's the seed and early stage. We really look for companies that can grow, and hence the phrase early stage, and then a bit further down the 4th bullet point about ability to rapidly scale towards growth. For us, growth is really key. The second segment is growth companies. These are companies that are near profitable or are already profitable, but are really proven, sizable businesses. We were keen to put these into the trust because these really de-risk the trust. Considering the history of the trust and where the trust has been through, we wanted to have a lot of high-quality companies in the trust. So therefore, we want to have a balance of both the venture and the growth companies. They are growth companies that in many cases we've also backed earlier. And the final area is life sciences. I've kind of skimmed over life sciences, but we do have a global life sciences practice. So if you think of many of the famous healthcare-backed companies of the last 20 years, we're also in many of those. It's interesting, when most people think of venture, they think purely of IT, and certainly Google's and Facebook's warrant that, but it's been interesting to see how many genuinely game-changing companies are venture capital backed. And so we do ensure that we cover venture, we cover biotech. One of the biggest challenges here, though, is you need to do a lot more reserving. They generally need to have multiple fundraisings, and so you need to reserve a lot more capital for this strategy, which suggests that it might be a bit more capital intensive. There's certain ways to ensure that it's not capital intensive, but the key is that you don't get caught in a financing round when the company needs a financing round and you don't have the capital or the market is not open. So we make sure we keep a bit more capital back for these life sciences business to make sure that we can cover through the full cycle. I think at that point, yes, that's good. At that point, I'll open it up to questions to see if anyone's got any questions about venture capital, about what we see as the opportunities and also the risks.